Hey, everybody, this is Charles Dobbins. Welcome to this week's edition of the Multifamily Investing Academy podcast. I'm here with Tom Dunkel of Belrose Storage Group. We're going to dig into self-storage today. And Tom, welcome to my show. And as we know, my award-winning show, okay?
Nice. Congratulations, Charles. Hey, yeah, it's great to be with you today. Thanks for having me.
Now, listen, I see what type of books you put behind you, and so I just have to hold. Oh, I can't. Oh, you know what? I'm on. Oh, this is the first time I'm using one of the fake backdrops.
Oh, okay.
There we go.
Yeah.
There we go. So now you can almost see it.
Yep.
Oh yeah. 10x is easier than 2x by Dan Sullivan. I see you've got the Benjamin Hardy. I see you've got the
That's
Who
right.
Not How. So you're obviously a Dan Sullivan protege, huh?
Well, a little bit. I read a little Dan Sullivan. I read a little Darren Hardy. Jim Rohn, Chris Voss. Warren Claff.
Oh my gosh! If you're going to start dropping names, hold on. This is not going to work for me because now I see that. Now that I'm going to have to go back to some old picture. I'm going to have to find the string of me, not the one with me and Michael Bublé. I could show you that one too, but let me see if I can find the one that
Okay.
that you will get. Oh, there's me with all these famous people that I was with. All these famous people. Hold on, oh man, I got to go way back into the archives for this one. No, Christopher Voss. I had lunch with him.
Oh, cool.
In Vegas, yeah. You want another really bad thing? It was so bad. I can't remember whose conference it was, but it was. I'm not gonna find it. It was. I'll find later, but somebody's conference, and it was lunchtime, and I came in a little bit late, and I sat down at this table. This guy's talking about negotiations and stuff, and I started launching it like I know what I'm talking about. I did not know it was Christopher Voss at the table with me.
Right. Yeah.
Oh, that was fun. That was a good time.
He doesn't. I mean, he's doing life and death negotiations.
But I did say to him, because I spoke to him like he was on my podcast, so I was like kind of interviewing him, and I said, "Chris, what's your next step?" And he said, "I've got two things in project right now. One of them is a real estate book." And I said, "Chris, I can't believe you said that, because as I was reading your book, Don't Split the Difference, I kept thinking to myself, this is great stuff, but it doesn't all translate well into real estate. If this guy could write a book on real estate, it would absolutely clean up." And he's like, "Really? You think so? You think so?" I said, "Yes, absolutely. You got to do it. You got to do it." Nice. So hopefully he'll come out with something on that. Now, do you go to a strategic coach? Are you I do
not. We're actually looking at that right now. My business partners and I are thinking about doing strategic coach, but we're involved in a couple other masterminds, and if you're not careful, you can spend your whole life going to conferences and coaching and stuff like that. But ultimately you got to bring all those tools back home and execute on your business. So we're kind of cautious, but definitely I know people have gone through it. Big value add for sure.
I've been with a strategic coach for about 3 years now, and it definitely has changed my business. And someone else recommended that I go try another one, and I did. And honestly, Tom, I felt like I was coaching them. And I thought, this isn't right for me. So, but the thing about Dan Sullivan, I go to his events once a quarter.
Yep.
And I sit there for the whole entire day with, I'm telling you, some of the most impressive people. I got guys doing, owning $1 billion worth of real estate in this room with me. And it's just such an amazing thing. And then when I leave, I can't figure out, what did I learn? Like, what did I learn today that I'm going to be able to apply in my business? Yeah. And honestly, every quarter, my business has grown every single quarter that I've been in there, and I can't figure out why. It's they one time asked me, go around the room and tell us why you're here. I said, Dan Sullivan is like a Russian hypnotist. And they're like, what does that mean? I said, when my father was a young man, he had a problem with chewing his fingernails. And so he went down, somebody said, go down to see this Russian hypnotist in Boston and he'll fix you. So my father drives all the way down to Boston, sits in this guy's waiting room, crowded waiting room. All of a sudden, after waiting an hour, he gets called in. He sits in this guy's room and the two of them just talk to each other for 10 minutes. And then my father gets up and walks out. And my father was like, what the hell was that all about? Why did I even bother doing that? And he never bit his fingernails after that meeting again.
Yeah,
so
how about that?
Dan Sullivan is a Russian hypnotist in my book. That's it. So
they're just on a different plane. It's like osmosis. It's
you
different.
Can't figure it out. You can't figure it out. So So all right. Well, let's get into Belrose Storage Group. First of all, why Belrose? What is that? What is Belrose?
Charles, it's a good story. So my partner Joe Downs and I, we've been business partners 13 years, and full disclosure, we hatch our best business ideas in bars. So our first company was called Oakmont Note Group, that we were in the distressed mortgage business, still are. That's because we hatched that business at the Oakmont Pub in Havertown, Pennsylvania. Now, as we, kind of moved upscale, we, moved into the nicer neighborhood. We started hanging out at a place called 333 Belrose Bar and Grill, which is a great hangout. Speaking of being around, top players and stuff, there's a lot of, wealthy, interesting, fun people in there. So we would go in there and hang out and have a couple drinks, grab a sandwich, and then we'd, flip over the napkin and start sketching out our ideas.
Yeah.
So Belrose Storage Group, full disclosure, is named after a bar.
Well, I tried to do that. I tried to name one of my companies for the same reason, but they say Chick-fil-A was already taken. So.
Right. Yeah. So,
Okay.
we like to have a little fun, and so we've named other businesses after other like beach resorts that we like hanging out at and stuff like that.
Oh, that's
so,
cool.
You got to keep your eye on the fun stuff.
All right. So I see that your buddy Joe Downs is a golfer. You a golfer? You're wearing the shirt. So
Yes.
All right. So pull out your gin app right now. You must have your.
Okay, I do. Yeah.
Let's compare. Let's compare.
Want to compare index?
Yep.
Okay.
See if you can. Mine is. Can you see that?
I can see it. You see mine?
Oh, you dog, you're giving me strokes, buddy. You're giving me strokes. Okay, good.
That's right.
Okay, so let's talk about self-storage.
Yeah.
There are a couple of big teachers in this business, obviously. One guy, everybody knows Scott Myers. Is he? Have you guys been through his thing?
We have, yeah. We've been with Scott for a while. We've actually been in his mastermind group since 2019.
Okay.
Speaking of a great group of people, yeah.
Yeah. So give me an idea. Do you bump up against them in competition? I know it's like with mobile home parks, there are two guys that teach it, and everyone that they train ends up being competition with the two guys.
Yeah, we don't really run into that, Charles. I can't say that we've run into any deal that I can think of off the top of my head where we had any competition from anyone that we knew or any of our mastermind members, including Scott. I mean, we've bought deals, and then people have come up to us and like, oh man, I looked at that deal, or but it was never like hand-to-hand combat, with a buddy kind of thing.
Yeah. Okay. Now let's talk about what your requirements are for buying. And this was taught to me early on by a lawyer who one of my students brought me a deal, and I looked at it and I said, you know what? It was in foreclosure. And I said, let's see if we can get another set of eyes on this. This was years ago. I think this was even, before Scott Myers was Scott Myers. And so I find a guy on LinkedIn, and he's a lawyer in Little Rock, Arkansas, and he owns 40,000 self-storage units.
Oh, wow.
And I got him on the phone and we had a great conversation. And he took a look at my numbers and he called me back a week later. He said, let me tell you what's wrong with this property. And he starts to rattle off exactly what is wrong with that property. And I said, oh, so you've obviously looked at this one before. He goes, no, I've never seen this one before. I said, so how'd you know all of that? He goes, listen, when you own 40,000 units, you know what to expect and what each one does. So what do you look for in an opportunity?
Sure. Yeah. Well, we look at a lot of things, but to keep it brief, we look at the market for sure. And so that's one of the similarities with multifamily. I believe you're more or less in the multifamily
Yep.
space.
Yep.
I've been an investor in multifamily myself as an LP since 2013, so I'm pretty familiar with that asset class as well. But yeah, we're looking at a strong market. We want to see at least stable, if not growing population. We want to see stable or growing jobs. We want to see low unemployment. We want to see low poverty. We want to see median household incomes in the 50, 60, 70,000. If it's too low, of course, we're going to run into poverty and delinquency issues, which is no good. If it's too high, those folks are buying nice big houses. They don't need storage. So we like to have that happy medium in there for sure. And we're looking, we're looking for path of progress. So we're there's a lot of people in the self-storage industry. Everybody knows that. So we're not banging our heads against the REITs in like the primary markets, Charles. We're out in the secondary, tertiary market. So like we're not in Atlanta. We're about a half hour outside Atlanta, as an example.
Now,
so
one thing you haven't mentioned, you mentioned all the right things about the market, but one thing you haven't mentioned about the market is the competition, and that's what he was talking about. So talk to that for a second.
Yep. I was going to get to that. So we do look at something called the supply index, right? And so supply index is basically a measure of how many square feet of self-storage is in that market as compared to the population.
Right.
And you do a little bit of math, and depending on the market, that number will turn out to be like maybe 6 or 7 square feet per capita. And it varies from market to market, but that's generally accepted as an equilibrium amount of storage. Okay. So if there's more than that, if we do our math and our analysis and it comes out to 15 square feet per capita, that's going to make us scratch our heads and be a little cautious, because it would indicate at a high level anyway that market may be oversaturated, right?
Right.
On the flip side, if we do our math and that comes out to 2 or 3 or 4 square feet per capita, that gives us an indication that this market may be underserved, but we have more homework to do. So we dig in, and because there are some markets where there might be 10 square feet per person, but as we do our analysis and we're calling around to all the facilities in that market, they're all full and they're all charging solid rates. It's like, well, for whatever reason, maybe it's near a lake, or maybe there's some other action going on in that market that's creating more demand than maybe somewhere else. And similarly, there could be a market where there's only 2, 3, 4, 5 square feet per capita. But as we call around, there's facilities that are not full, and maybe their rates are lower. And so maybe that's a little bit too tertiary, it's a little bit too rural, right? So we definitely are looking at the competition for sure. And we parse it down a little bit further, Charles, and looking at comparable properties. So in other words, if we're looking at a facility that's only non-climate controlled units, we're going to be comparing, we're going to be looking at the competitors that are also non-climate control. And so there may be an indication, if there's a big spread between the non-climate control rent and the climate control rent, maybe we should be looking at either adding climate control or acquiring climate control in that market, because there's solid demand for it as shown by the spread and the rates.
Yeah. Interesting. Now, let me ask you this: out of all your years in self-storage, has that index changed as an equilibrium? Like, as the world grows, does that number change?
Sure. Well, it definitely varies from market to market. So, like as you start to get in the South, right, which is where we're focused, because people are moving.
They don't have basements.
There's no basements, and it's too hot in the attic.
Yeah. Interesting.
So those markets do tend to have higher supply index equilibrium. So like in Georgia, for example, it's more like 8 or 9 feet as compared to New York State, which might be more like 6 feet.
Interesting. Okay. That's very cool.
Yeah.
Now let's, let me ask you this question, because this one's always thrown me for a loop when you're doing an analysis of property. What's typical vacancy for you guys? Like, if we, in multifamily, in order to get a loan, you need 90% occupancy for 90 days. And in self-storage, I don't think that's right. What's the right number?
Yeah, it's not quite like that. I actually have a friend who's in the hotel business, and he says, if we're more than 90% full, I'm not charging enough.
Exactly.
And
Exactly.
so it's the same thing kind of
But the thing about him, the thing
yeah.
about him is he can change his rates on a daily basis.
Yes, he
You know?
can. Yep,
Yeah.
yep. And it's a similar kind of thing in the airline industry, right? It's like, they have very dynamic pricing, right? And they know
Exactly.
they're trying to
Yeah.
push that demand curve,
Yeah.
see what they can extract.
Exactly.
So we kind of do that same thing, but generally speaking, yeah, the lenders are going to be looking for what they call a stabilized facility. So that means 85% or greater occupancy. But once we get in there, we're definitely trying to push rates, and that's part of our analysis before we even acquire the facility is where do we think we can push rates, and
Where's the value?
what does that supply demand curve look like?
Yeah. What type of cap rates do you buy these properties at?
So, I know folks out there love to talk about cap rates. It's for us, it's more of an output of our analysis, but generally speaking, when things were really hot, last year we were buying as low as maybe a 5.5 cap. But the deal that we're closing on next month is actually 9.5 cap. Believe it or not.
Okay, bravo. We always say bravo to you, bravo. Now, are you seeing things cooling off in the self-storage world?
Not really. I mean, it's still definitely competitive. I do think, for a while there's definitely a gap in the bid ask spread between, what sellers were wanting and where our numbers were working. But
So how'd you pull off this? How'd you pull off this 9 cap?
So talk about a great win-win story, right? So we're buying it. It's down in North Carolina. We're buying it from literally a mom and pop, husband and wife team that own and run the facility. They just stumbled across it about 5-6 years ago as a foreclosure. A bank had taken back it was brand new property. It had just been built, and the developer, I guess, ran out of money, had to turn the property over to the bank. They bought it for $150,000.
Oh my gosh.
And then they leased it up. They did their work, got it filled up. Now we're buying it from them for 1.5 million. So they've 10x.
In other words, they bought it at a 22 cap, and so.
Yeah. So talk about a win-win, right? I mean,
yeah,
they're crushing it. So they're going to be off in retirement, right?
Good for them.
And we're picking up a great asset at a really nice, favorable price. So our investors can enjoy some nice returns as well.
Oh, that's fantastic. All right. So let me see. I got all these great questions. Okay. On your website, you've got realized property, but then you got properties in transition. What does that mean?
Yeah, so we're generally, Charles, our strategy is we're buying value add self-storage facilities, right? So those are existing facilities that are being poorly run, and so we come in with our professional management team and we turn them around, and then we exit them in a 2 to 3 year time period after we've gone in and worked our magic. So we have had 3 exits to date. And but the rest are what we call in transition. So we're in there, we're doing our blocking and tackling, we're implementing our technology strategies, we're pushing the rates like we were talking about a minute ago, and we're executing on our turnaround strategy, our value add strategy.
Okay, but it's typically a 2 to 3 year hold for you. That's all you guys do? Good.
So that's where we're at right now. As our company continues to develop and we're looking at other opportunities, we are starting to look at ground up development. So we actually have a couple of those in the pipeline as well.
Okay, that was one of my questions. Is one of the issues with self-storage is it's got such a low barrier to entry. I mean, you can contact these companies that will throw them up for you in no time flat. But you're starting to do some ground up construction, so you're looking for raw land. So how are you sourcing all of that? Because obviously it's easier. You can be a little bit more focused with buying an existing because somebody's just bringing you an existing. With ground up, you got to throw in a little imagination, a little creativity, like, hey, what do you think about, Transylvania, Pennsylvania? And, you guys have to find a compelling reason to be there. So how do you source these ground up deals?
Yeah, well, I would argue that there are high barriers to entry. I realize, people's, and let's face it is a simple business, right? It's concrete floor with, metal boxes with concrete floors and roll up doors, right? So
let me just tell you a story. I owned a god awful property in Texas many years ago. And I was going through a heat wave of 116 degrees nonstop. And I happened to be in the management office on a Sunday morning, and the phone was not stopping ringing. So I pick it up, big mistake, and I got an earful from a guy that day, screaming, said, "My air conditioner is not working. I have to go to the hospital." And screaming at me. "I'll get you a new air conditioning unit." So I called my maintenance guy who lived on site, and I knew that we kept the air conditioners down in our self-storage box down the street, and we had to keep them there because they were getting stolen off of my property by my maintenance people. And so I kept them in self-storage. And on a Sunday morning, 100-degree temperature, I drive down to Bob's self-storage and I go on there, and it is pristine. The parking lot is perfectly paved. It is as quiet and peaceful as it's sunny. You could hold a church lesson out there that morning. And I thought to myself, man, the owner of this place is not getting a phone call on a Sunday morning from a screaming tenant. So, yep. So that was the difference, I thought.
Yeah. So we're big fans of the self-storage industry for that very reason. It's what we call non-habitational real estate, right? Because our tenants, sure, we have tenants who complain about this, that, or the other. I mean, you're still dealing with people, but they're not the complaints that you're getting over at a multifamily or other rental property.
Yeah. So how do you source the land deals?
Yeah. So the land, I would say there are definitely barriers to entry because here's the thing, you have to have the proper zoning, right? Yeah. And a lot of municipalities, they don't like self-storage because it doesn't generate a lot of tax revenue. Yeah. For the municipality, right?
But it doesn't generate a lot of kids going to the elementary school either.
That's right. But municipalities do reluctantly, sometimes agree to have self-storage built because their community is wanting it, right? I mean, self-storage is becoming more and more popular, right? Years ago, it was only maybe 5% of households are using self-storage. Today, it's 11% of households. Okay. I know, a few percentage points might not sound very exciting, but when you consider there's 120 million households in the United States, every 1% increase is 1.2 million more self-storage customers. Wow. So, and the demand, there's only 55,000 self-storage facilities in the country. So it's definitely an untapped market. And if you talk to millennials, who are the biggest generation right now, they are using self-storage as part of their overall housing strategy. So I think that 11% that we're seeing today could easily double in the next 10 years.
All right, you want to know why it's working this way? Because the people my age can't give away our bedroom sets to our kids like we did with our parents. All these kids want to run out to IKEA and buy brand new.
It's right.
We're stuck with all these bedroom sets. After my father passed away, I had 8. He had 4. He had 2 4-bedroom homes, and he had a brand new queen bed in every single one of them. And they're all sitting down in my basement right now, and I can't give it away to my kids.
Yep. I understand. Yep. I'm going through the same thing right now with my mom. She's downsizing, and she's, texting me and my brother and sister like, hey,
hey, do you want this?
Yeah. Do you want great Grammy Catherine's, China and stemware? Mom.
Oh, China. China's like, sell your stock in China. Kids nowadays don't want it. They just don't want it. What are we going to do with this? I don't know. What do you mean? What you take it, you go put it in your hutch, like
right? Exactly.
30 years, only using it twice a year.
Right. I mean, it means you're an established adult now. Exactly. You gotta have the China in the hutch.
Exactly.
Come on.
Okay. So
grow up.
Exactly. Be like your father.
That's right.
All right. So listen, let's last couple of minutes here. I got to talk to you about money.
Yeah.
So I want to talk to you about debt equity. I want to talk to you about bank financing, seller financing, and I want to talk to you about the equity structure. So lay it on me, Tom.
Sure. Yeah. So cost of debt has definitely increased recently. Last year we were doing deals in the 4s and the 5s. In like the course of like a couple of months, we started getting term sheets that were more like in the 7s and the 8s. And then now actually the deal that we're closing, the sweet deal down in North Carolina, we're actually getting 9% debt on that. But again, we're okay with it because the cash flow is still there and it fits in with our strategy. But what we're seeing more of today is seller financing. And we love seller financing because obviously you're dealing with a seller, you're not dealing with a bank. So there's much more of a streamlined, I wouldn't even call it an underwriting process. It's a streamlined process to get that debt in place. And the sellers that are arranging financing for us that are holding that note, they're typically only wanting interest only. So it's a win-win, right? They're selling a facility that they don't have to worry about anymore. They're not going to own it. They're not going to have to worry about the management and this and that, but they're still going to be getting some cash flow from it, and they get to defer their taxes. So big win for them, big win for us because of the reasons that I just laid out. So we're getting those at, maybe 4 or 5. I think we're going to be closing one in a couple months. It's going to be 6% interest only. So way better than the bank terms that we're seeing right now. So that's a big
one. What do they want down for? Like, what's the LTV on that?
Yeah, so it varies. We're typically so we're buying a facility for $6 million, and the seller's holding $5 million.
Really? That's
great. So it's a pretty juicy one. We bought one last year that we bought it for $6 million.
First position on that?
Yeah, the seller's in first position.
Right. So okay.
Yeah.
Right. Now, are you selling any of your properties with seller financing?
No, we haven't done that. No.
Yeah.
I mean, that's really as a seller, you're typically only in a position to do that if you've owned the asset for a while and you've built up quite a bit of equity.
And the thing is, you've got your equity investors behind you, and they want their money back.
That's correct. Yeah. So good segue to the equity side if you want to talk about that. So yeah, we are syndicators. So we do put groups of real estate investors together to put up the equity to buy our self-storage facilities, and we're always chipping in money as well. So yeah, our typical equity raise is in the, I would say, $1.5 to $3 million range.
Yeah.
And so our average investor is putting up $100,000. Our investors get a preferred return, which ranges between maybe 6 and 8%. Depending on the deal. And we, like I was mentioning earlier, our turnaround strategies on value add typically are 2 to 3 year holds, and then we exit the facility. And knock on wood, we've had some good exits where we've had our investors take their profit off the table, but then they'll reinvest the principal in the next one, and they'll bring their friends. So that's a little anecdotal evidence for us that we're doing a pretty good job for our investors. So yeah, they get the pref return, and then they get a profit split at the end. And so we gear that to get our investors like a high teens overall return annualized.
So have you finished the raise for this North Carolina deal?
Actually, that one we're doing in-house. We're taking that one down ourselves, but we have one coming up right behind that where we are going to be raising $1.5 million.
Oh, you bastard! Okay. I know exactly why you're doing that one in-house. I'd be doing that one in-house all day long. So good for you guys.
It's a little longer term play, actually. It's got a little hair on it, to be honest. It's a nice little facility, but it comes with a bunch of extra land. And so we're going to be over time, in phases, we're going to be expanding that. So it's a tough story for some investors to get their heads around. We like to go to our investors with, very clean, clear stories so that they can understand it, get their heads around it, and not have to worry about it on the golf course.
Is the land zoned for multifamily?
Good question. Zone for commercial. So we're doing all that due diligence right now.
Well, I'll tell you right now, the hottest market. I just had a guy on my podcast, a couple of weeks ago. Industrial. You throw up those condo bays, and you'll sell them in no time flat. No time flat.
Yeah, interesting idea. One of what we are looking to do on the rest of the parcel in North Carolina is RV and boat. That's
Yeah.
another growing area. So yeah, two emerging areas that we're seeing in storage compared to traditional, which are still going to continue to do that. But you just mentioned contractor, right? So the next facility where we're raising $1.5 million, that's down in North Carolina as well. And those are big, large format storage units that are primarily used by contractors, but they're also big enough for someone to park their RV in there.
Yeah.
And we're finding that the contractor storage is a potential growth area for us. So we're looking at that for sure.
Cool. Very cool. Everyone, his name is Tom Dunkel. You can find him at 333 Belrose, having a couple of cocktails. What do you prefer, rye or whiskey for your Manhattans, Tom? Which one?
It's a good question. Hey, did you know, here's a little fun fact for you. Did you know that Pennsylvania is, I'm in Pennsylvania. Pennsylvania is to rye whiskey as Kentucky is to bourbon. Did you know that?
No, I did not know that.
Back in the day, Pennsylvania was the big place for rye. And now that rye whiskey is making a comeback, there's a lot of little local distilleries popping up here in Pennsylvania. So
because I always get Bullitt, which is Bullitt County in Kentucky.
Yeah.
I don't think of Pennsylvania. All right. Well, so give me the name of a rye in Pennsylvania.
Dad's Hat.
Dad's Hat. Okay.
Give it a try.
Now, here's the thing is you got to make sure that it's not like a top shelf rye where you're going to cut it with your vermouth and your bitters.
That's right.
So, all right. Dad's Hat. I'll be looking for it.
They've got a few different levels. So, you can go for like the high good stuff or the lower stuff to mix in your Manhattan.
All right. Well, I call it my mother's Manhattan. That's all she ever drank. So, Thomas, say hello to my brother Lenny because he's listening right now, and he's my number one listener. So, say hello to Lenny.
Awesome. Hey, Lenny, thanks for listening, buddy. Appreciate it.
Yeah. He just poked his head up from his microscope and just to say hello back to you, Tom. So, all right, hey Tom, good to meet you, man. And I love the deals. These deals sound fantastic, and I think you just turned a lot of people, onto self-storage just by listening to some of these numbers. Good stuff.
Yeah, thanks, Charles. This was a lot of fun. Appreciate you.
Always is. Thanks, buddy. I'll talk to you soon.
Okay, take care.
See you on the golf course.
Yes, sir.
You're going to give me 7 strokes. See you, man.
One aside, I think, is what I saw.
That's about right. See ya.